AT&T is what's known as a dividend aristocrat, meaning that they're a member of the S&P 500, and they've not only been paying dividends, but they've actually been increasing those dividends every single year for the past 25 years. So the fact that AT&T has actually been increasing their dividends even during recessions and market crashes is kind of a nice thing to have, considering how scared investors are right now about the economy and about the market. But when looking at the stock itself, it's already down over 20% year to date, and even giving them a nice 5-year buffer to get their act together, they're still down over 13% in the past 5 years. So with a price that's been beaten down a bit, a high dividend yield of over 6%, and some possible growth drivers like 5G technology and their upcoming streaming service that is set to launch in 2019 thanks to a huge acquisition of Time Warner, is AT&T stock worth investing in, or is this just another case of a high-yielding stock tricking investors into investing in a stock that couldn't even bring positive share price returns in the past 5 years? Let's find out. What's up everybody, my name is Ala and welcome to my world of stocks. So today we'll be taking a look at AT&T, which is a telecommunications and digital entertainment company. Now they offer telephone services, both landline and the much more important wireless offerings through AT&T and subsidiaries like Cricket Mobile, which is actually the service provider that I personally use. But they also acquired DirecTV a few years ago to complement their already existing Uverse cable offerings, but they continue to lose subscribers there because of the whole cord-cutting movement, which is only being partially offset by some success in their DirecTV Now service, which is a subscription service that lets you stream cable television along with other on-demand and DVR features. And then thanks to the acquisition of Time Warner, they also have what everyone is talking about right now, and that's their upcoming all-in-one video on-demand streaming service launching in late 2019, which should be a direct competitor to the likes of Netflix, Amazon Video, Apple's service, Hulu, and of course the new Disney service called Disney Plus that is also launching around the same time. Now we'll talk more about their business a little bit later in the video, but first, let's take a look at their stock. They currently trade for around $30 a share, and their stock price has been kind of all over the place. They have periods of time where they do pretty well, but then they slide down, they tend to go back up, they tend to go back down again, and the cycle just kind of keeps repeating, but they're overall trending downward, down over 20% year to date, down over 10% in the last 3 years, and down over 13% in the past 5 years. And even their 10-year chart doesn't look all that much better. So just from this standpoint alone, it's not really a stock that interests someone like me who is a long-term investor. And I like to think of myself as a patient long-term investor, but I can't go an entire decade and not see some really big gains, and that's really been the case with AT&T. However, I do also consider myself a little bit of a dividend growth investor. So when looking at dividends, AT&T has actually performed pretty well. Now, companies in the telecom industry usually pay some of the highest dividends because they're able to generate so much cash from their enormous infrastructure investments. In fact, I believe the telecom industry averages a dividend yield of around 4.6%. But according to seekingalpha.com, AT&T has a dividend yield of over 6.5%, with $2 being paid out per share. And that's also massively higher than the S&P 500's average yield of around 1.9%. And for it being such a high yielding stock, their payout ratio isn't too bad either, just barely over 50%. Now I do like my dividend growth stocks to be under 50%, but at only 7 percentage points above that, it really isn't too bad. And they also have a massive 34 years of consecutively increasing those dividends every single year to help attract me to the stock even more. However, again, according to Seeking Alpha, their 5-year dividend growth rate is extremely low at only around 2%. So as a dividend growth investor myself, this stock just doesn't really fit my specific needs in both their price performance or their growing dividends. But if you're a dividend income investor, then you probably care more about that yield being decently high, and you also want to see a very good track record of not only paying dividends but also increasing them. in which case AT&T starts to look much more attractive. Okay, now let's transition to their valuation. Let's take a look at their balance sheet. We'll also take a look at their most recent quarter to see how their business is performing so far. And then we'll also look at their future potential closer to the end of the video, and we'll take a look at their upcoming streaming service that should launch in 2019. Now, according to Yahoo Finance numbers, their valuation looks pretty good. They're currently really close to their 52-week low of around $29, which may represent a good entry point, and especially if you can be patient and average down as it drops more. Their trailing PE is also good at less than 6, which is lower than both the telecom industry and the broader market, and even though their forward PE is a little worse, it's still pretty low at around 8.5. Their PEG, PS, and PB ratios all look pretty decent as well, sitting between 1 and 1.5, and their profit and operating margins are at least in the double digits at 20 and 16% respectively, which is higher than the S&P 500 at around 12%. Okay, now let's take a look at their balance sheet, but just keep in mind that some of these numbers might be kind of all over the place because they've had some really big acquisitions. In fact, I believe they acquired DirecTV a few years ago. I think that was back in 2015. And then they also acquired, of course, Time Warner this year back in June, and that was for a whopping $85 billion. And when you include the debt that went along with it, it actually goes up to $108 billion. But looking at the past 4 years, you can see just how large this corporation is, reaching as much as $50 billion in cash just last year, with almost $80 billion in current assets and over $400 billion in total assets. But current liabilities was also extremely high at $81 billion, and total liabilities were at over $300 billion. But that's also last year, so let's try to get a more recent picture because of all the acquisitions and activities. So looking at their latest quarter, this would be the third quarter of 2018, cash dropped all the way down to $8 billion, with current assets dropping to $53 billion. Don't get me wrong, that's still a lot of money, but the problem is that their current liabilities is as high as $65 billion, and I never like to see a current ratio that favors debt over liquidity, and even their long-term debt is also very high, as high as $168 billion. And while their total assets are very high as well at over $500 billion, that becomes less impressive when you consider that their total liabilities clocks in at over $350 billion. Having said that, because of those acquisitions that were necessary in order to save AT&T's future, you're probably not investing in AT&T for their balance sheet. You're more likely investing in them for their low valuation and their current and future potential. Which leads us to their most recent performance, again in this third quarter, which is actually their first full quarter of having Time Warner included in their overall business. Now you might be wondering, why has their stock price been performing so poorly? And when you really think about it, this is a company that has had 7 straight quarters of year-over-year revenue decline. So that's almost 2 years of having revenue decline year over year. That's not a good sign. And I think there's a lot of reasons for that, but 2 reasons that kind of stand out to me. One is because you're having the whole cord cutting movement. So this is a company that is transitioning from offering subscription television to more on-demand services. And then also you have the whole movement of switching from contract cell phone plans that are much more expensive to much cheaper prepaid offerings. But that's the last 7 quarters. So how did they do this past third quarter? Well, they actually increased revenue year over year by as much as 15%. That's fantastic news, right? Well, not exactly. That's only if you include Time Warner for the third quarter of this year and not include them in the third quarter of last year. So while they did technically have an increase of 15% thanks to Time Warner, that increase drops all the way down to barely above 0% at 0.2% on a pro forma basis, basically meaning that you include Time Warner for both years. But hey, at least it's not a decline, right? And on the bright side, adjusted EPS grew 22%, cash flow from operations also grew by double digits at 14%, and free cash flow to date is at $14.4 billion, with full year guidance at around $21 billion, which should help them pay down some of their very large debt. However, analysts were expecting slightly higher results For example, they wanted 95 cents EPS, while AT&T came in at only 90 cents. So shares still ended up dropping by around 6% on that earnings day. Now, as far as their different segments go, it's not looking too pretty. Mobility did impress with wireless revenue up 5% and service revenue up 2%, with very strong prepaid ads of over 500,000, but postpaid ads came in much lower at only 69,000, but that's to be expected as more people ditch contracts and go for the much cheaper prepaid options, either from AT&T or even smaller subsidiaries like Cricket Mobile. But overall, this segment did do pretty well, and we should probably continue to see decent results throughout next year as well, with 5G starting to roll out, which, by the way, AT&T has been investing heavily in that 5G infrastructure in order to be a top provider of 5G services, which will provide dramatically faster speeds for data-hungry customers and could be a really big play on the growing Internet of Things market as well. But looking at the other segments like entertainment and business wireline, there we saw a revenue drop by over 5% and 4% respectively. And when looking at entertainment, that includes their satellite TV and video on demand services, which they mentioned that DirecTV Now added 49,000 customers. But what is not listed on this particular slide is that they actually lost over 350,000 subscribers from their satellite TV business. And I think that's clearly a result of the cord cutting movement. Now, I have two different thoughts on that. One is that I don't think the cord cutting movement will slow down anytime soon, and I don't think the bleeding will stop. But I also think that, you know, for all the bears that were saying that the whole acquisition of Time Warner was a bad idea, I just couldn't disagree more. I think that AT&T had to adjust. They had to fight off these online streaming services from Netflix and Amazon, and now it's going to be Disney, Apple, a bunch of other corporations. They got to fight back, and they got to offer their own streaming service if they really want to compete here. And in order to do that, in order to compete with the likes of Netflix, Amazon, Disney, things like that, they're going to need some more ammunition, and that's exactly what Time Warner gives them. In fact, with the acquisition of Time Warner, AT&T gains the rights to a host of entertainment content, including Turner, Warner Brothers, and even HBO. This includes television and movie content from networks and brands like Cartoon Network, CNN, TNT, TBS, Warner Brothers Pictures, New Line Cinema, Castle Rock, and the list of content just goes on, including the DC universe, so they can also get really popular content from Batman, Superman, and the rest of the Justice League characters. Now, when looking at HBO, they have a ton of really good original content. You're talking about Game of Thrones, Westworld, they had other stuff like Curb Your Enthusiasm, they used to have Entourage, things like that. But I never really saw them as a major threat to Netflix or even Amazon, which, by the way, HBO is actually offered on Amazon for an additional fee. But if you launch a new comprehensive streaming service with all of the Time Warner content, or at least a lot of it, and it's also fueled by HBO, then I think you have potentially a pretty big player in the video on demand streaming market. And you know that AT&T means business here because they've already shut down 3 of the smaller niche streaming services in Drama Fever, Super Deluxe, and Filmstruck in a move to focus more of their attention and budget on their new, bigger streaming service, which, by the way, we don't know exact pricing of yet, but I believe the CEO of Time Warner mentioned in an interview that it would cost more than HBO Now, and that service costs about $15 per month. So I'm guessing that it will probably cost more than Netflix, Hulu, or Disney+. So in conclusion, I think that AT&T stock hasn't really been anything to get too excited about in recent history, and I think that their low share price is a reflection of that. As a long-term investor, their poor performance for the past decade during a very strong bull market is a big red flag to me. And even as a dividend growth investor, their very low dividend growth rate is another concern. But having said all of that, I also think that this is a stock that is priced pretty low at a time where investors are screaming about how high the market is and how expensive the market is. And while I do think that parts of AT&T's business will continue to struggle with the whole cord cutting movement continuing, I also think that a lot of that negativity is currently being priced into AT&T and has been for a while now. So in the short term, I do think that this is a stock that continues to struggle, but in the long term, I do think that there are some possible growth drivers as well. when you look at 5G technology and when you look at their upcoming streaming service, both of which should really start to launch and ramp up sometime next year. And the good thing about AT&T is that while you wait for those things to get up off the ground, you get a pretty nice dividend stock with a solid yield, a very high yield, and an incredible track record. But for me personally, I just don't think that AT&T really fits my specific portfolio as a long-term investor or as a dividend growth investor. But you might be different. Your portfolio might be different, and AT&T might be exactly what you're looking for. Maybe you're a dividend income investor. Maybe you're looking for a really big corporation that has been beaten down, and maybe you believe in AT&T's future. So if that's the case, then maybe you should look into AT&T and research them more. Full disclosure, I do own Disney stock. Disney is actually my largest stock, and I also own Amazon stock. I don't think I own any other like competing stocks, but just to kind of give you a quick disclosure. Now, I'm saying that I won't own AT&T stock right now, but if they keep declining in share price, it's going to get more and more attractive to me, and I may open up a position on them in them at some point. And if I do, I will definitely make an updated video and let you guys know. But just at the current moment, I just feel that there's better options out there for me personally. And so that's why I'm not investing in AT&T yet. But who knows, anything can happen in the future. But who cares what I think, guys? I really want to know what you guys think. Make sure you leave me a comment down below. How do you feel about AT&T stock? Do you agree with me? Do you disagree with me? Are you invested in AT&T? Let me know down below. I couldn't fit everything into this video. I can't make my videos super long. I always get comments saying, why don't you talk about this? Why don't you talk about this? I can't talk about everything. I apologize for that. Videos would just be way too long. But anyway, I hope that you did enjoy this video. And if you did enjoy this video, please support the channel by hitting the like button. It really helps me out more than you could ever know. And I will catch you guys in the next video. I hope you all have a wonderful, beautiful day and that you take care. Bye-bye.